Forster, the co-founder of Lyra, a DeFi options protocol. Nick, how's it going?
Hey, yeah, hey Greg, it's going well. How about you?
Great, great. I'm super excited to have you on. I mean, I've been following the Lyra project now for a while, and it's a super like useful AMM, and I'm able to trade some great option positions there. So I kind of wanted to jump into your background before jumping into Lyra. You were a trader at SIG. Maybe we could start there and start like how did you get there? Did you know you wanted to be a trader while you were in school? So on and so forth.
Yeah, sounds good. So I studied maths at university, and I hated networking. It was like one of my least favorite things. But a friend was heading to a networking event that was a poker tournament, which was, how SIG did their sort of recruiting through poker. And that was a game I loved growing up, played a bunch with my friends. So I went along to one of the SIG poker tournaments here in Sydney, went pretty far and kind of really got a bit of a taste into like what the trading, mindset was and met a few of the traders there and just loved it. So, went really hard trying to get into SIG and managed to go. Yeah, I got recruited, went to the Sydney office for a couple months and went over to the US and ended up trading there for 3 or 4 years. Trading equity options. So on that desk in Philly. So had a really good time there.
Oh, that's fantastic. And SIG is known to have a really good sort of education for new traders and options education. How was your experience in that? What, can we maybe just touch on what do you guys do in that education?
Yeah, it was awesome. SIG do have a really great program for it. They teach you poker. So we like as part of the classes, you spend like a year there really ramping up. You do mock trading, so you're out there like, kind of out loud with a whiteboard, calling out trades and making trades with people, doing all this mental math. You get to sit there on the desk and watch traders. You get a small book to start off, and you can ask heaps of questions. It's very much like an old school environment with lots of traders crammed into a small space, and it's just very fun. You get looped into absolutely everything, and so you kind of sit there for like a year. You do these classes, you learn poker and decision making and that sort of stuff, and by the end of that time, you're kind of all ramped up in how to make good decisions and kind of get to that mindset.
And is SIG only a market making firm, or are they also a prop firm? And if they are a prop firm, what kind of strategies did you do, and what kind of stuff did you look at?
They definitely prop trade. They trade, like it's all. I think the company is privately held and things like that. So it's all their balance sheet. There's lots of different things that they trade. I mean, their specialty is in volatility trading, obviously with options, which is what I was doing. Lots of quantitative strategies and things like that. As well as they do a bunch of different stuff at SIG, including like they have a sports betting desk as well. I think do sort of like market making on sports betting like at big size, which is quite fun. So but they really run the gauntlet on strategies, and it can range from like very automated to like quite manual, right? Like just traders talking about something that they're seeing and something unusual and having to adapt to that quickly. And that sort of like manual aspect actually I really enjoyed. It's not just that you're not just there clicking buttons all the time. Or just letting the algorithms run. You have to really think about, particularly in large risky situations, what you're doing, who's making the bet, that who's putting a bet to you, and why they're doing that, and how you should respond. So I found that part really the most enjoyable part.
And was that what you were doing? Sort of like a manual decision making, discretionary decision on equity options?
Yeah, it's both. So there's like you when you run a book, I traded a book of like 50, 60 different stocks, and you sort of watch the trades coming in on your screen, and you're just like picking out the sort of strange ones that you see. So like a lot of that's automated in the back end, but you pick out the interesting ones, the bigger ones, and you sort of respond to that. You move your vol surface around, you sort of react to what's happening in the market. And it got pretty crazy there for a little while during the pandemic, and then the GameStop saga. I was there for that. It was obviously a huge period for all of the options market making firms, and there was sort of all sorts of crazy situations blowing up left and right. I think I had a Melbourne Capital stock that went haywire one morning, and all of these sort of like crazy situations that you can't really put into an algorithm. Sometimes you kind of really have to react manually, and I think that was like a big time. Like if you were out there during January 2021, just letting your algorithms sell a bunch of tail options because that's what they want to do, because they seem good on paper, right? To what you'd calculate, you'd get absolutely hosed. You'd lose your house because you have this sort of reflexive effect of people buying gamma and then the stock ripping up, and then market makers hedging, and we also what happened with GameStop, and so like that kind of just logical thinking and intervention was really critical in those sorts of situations.
Yeah, that makes a lot of sense. I always kind of have the same theme that when I think about discretionary traders versus quants. I think that quants do really well in sort of normal markets where your models work, but then there's these events that everything goes out the window, and essentially only a human trader can really recalibrate quickly enough to really make money. And those are typically good markets for discretionary traders if you can figure it out. That's at least that's my
Definitely.
thesis.
Definitely, yeah. That's where you have your best days too, right? Like on those sorts of days, right? There are a few days a year that really define how you go for the year, and if you make the right calls, you can do really well. And,
Yeah.
And on the flip side, if you screw it up, well, that's also tough.
So I do want to move on away from SIG, but I just have one more question. So you mentioned you were there during the GameStop sort of saga. Anything crazy that you saw during that?
Just the craziness of how trading was. Like GameStop, I think, went from $10-20 to $400 in a matter of a week or two. Just insane trading situations where like the short rate blew out. I think the forward for GameStop, in a few months was trading like $70 when the stock was 400. It was really hard to find borrower on the stock. Just really weird option situations that arose, and just very strange distributions of what the options were implying was going to happen to the stock. No one really knew what was going on. It was just very, very interesting trading situation. There wasn't, like that was kind of the thing I'll say about it. It was just so interesting to watch. And you have these, everyone's checking Reddit in the morning now, like as part of your daily routine as a trader and things like that. You're like, what's going on Wall Street bets? Am I next? Like, is there going to be another stock? There's AMC that sprung up. There's all these other stocks, and you're kind of sort of nervously checking your tail risk to make sure that Melbourne Capital wasn't short any of your stocks because you knew the mob was coming. So it was a really crazy time.
Yeah, that is fascinating. And that's a good point about the forwards, because I've noticed crazy forwards in a few stocks before where you're looking at options that are 2 years out. And I mean, the forward is if you just look at like the just basically the risk reversal for, not the risk reversal, but the put and call parity for all those options, you can see that like, okay, it's assuming that the stock price is $70 like you mentioned, whereas today the price is 400. Is that something that you think there's opportunity in, like where the forward is so differently priced than the underlying spot price that long-term calls are really cheap and long-term puts are really expensive, and is there stuff to do there? Is that something that you found?
I think it generally indicates like an interesting trading situation. I wouldn't say necessarily indicates that there's edge there. I'd say the forwards are usually pretty correctly priced, but it does create some interesting things. I remember like with GameStop specifically, I think it was like, and I don't know if you're familiar with the Nigerian brothers, but like they're like, these sort of like CNBC option trader people that are on TV. Like they get it wrong a lot of the time, but they also got it. I think one of them got it extremely right with GameStop. I think he did the structure where the stock was 400 and he was selling like the 100 put and then 2x the 60 put or something like that, when the forward was down in that range. And he was really making this bet that like, if GameStop sort of reversed and went all the way back down to sort of $60 or $50, that vols would be absolutely crushed, and particularly down to those downside nodes, which were most market makers, right? When you price a 90% down move in stock or an 80% down move in stock, those like 60 puts are going to be really rich because it indicates panic, it indicates sort of craziness, but that hadn't been priced into the market when he looked into the structure, and that 1x2 was extremely sharp. He was like, well, like actually in GameStop, people get excited when this thing goes up and they get bored when it goes down. So like in theory, those bottom nodes should have the vols more crushed than the 100 puts, and those sorts of opportunities and that sort of thinking can really go a long way in those scenarios, as opposed to necessarily having the best algorithms or the best hardware. Like you kind of just have to figure out what what the psychology is that's driving the movements in the underlying, and that's, yeah, I think those are the kind of opportunities that present themselves when things get hairy.
Yeah, that's super interesting. That's great. I remember when I was trading Beyond Meat, like right when it IPO'd, and it had that weird Ford situation. It had a lot of
Yeah.
short interest. You couldn't borrow it, couldn't go short. Everyone was already short, and so those long-term calls were pricing in like like the stock was 50% lower than the spot price. And so I always kind of have this thesis of like, well, if everyone's already short, there's potential for a short squeeze. And so that could be a reason to get long those calls. And if it actually goes down, the forward, people will cover their shorts and the borrow costs will go down. And then that forward should come up. So you kind of have the situation where like both directions have a little bit of hedge built into them. Anyways, that's cool that you talked
Yeah,
about that.
it's a great take. Yeah.
Yeah, I really like those forward situations. But anyways, to move on beyond that, so you're at SIG. When do you know, hey, I'm looking at crypto. This is the most interesting thing. Not only that, but I want to build in crypto. So were you already trading crypto? What kind of got you to move from traditional equity options to building a DeFi options protocol?
Yeah, so my sort of crypto starter story was, back in, I think, 2015, 2016. Do you remember, the guy Craig Wright, the sort of the guy who claimed he was Satoshi, Aussie guy? The Australian Federal Police, the tax office, raided his house, which happened to be like a few houses down the street from where my friend lived that I used to go to all the time. And this was like 2015, 2016. And I was like, just started getting, and then I was like intrigued by that story and Bitcoin. And that's kind of what got me reading about it. And then that, pretty quickly led me to ETH and Ethereum, back in 2016, got really interested in it, was sort of like there, kind of trading ETH during the DAO hack, and kind of, watching panic selling, when ETH was, and I look back at those trades now, it's those terrible trades, some of the worst trades I've ever made. But like, that's kind of what got me really interested. And I was kind of following ETH really into the potential, of like a decentralized global settlement layer and a network of of compute power that can do all sorts of crazy things, and was really into it, I guess, from then. And that led me to meeting Mike, who's at university, who's now one of my co-founders, who was doing his honors in blockchain, like computer science background, and we sort of kept in touch. I went off to SIG, started trading for a few years, kind of like loosely kept in touch with ETH. Crypto and Ethereum specifically, vaguely sort of realized what was happening with DeFi, some of it not too much. And then Mike kind of reached out to me sort of mid-end 2020 and was like, hey, he was working at Synthetics. He'd been working at Synthetics for 4 years. He was on the sort of white paper for the original version of the protocol. And he's like, hey, I think there's a big opportunity in DeFi options. And that really started to go, I started to look into, what DeFi was properly, dived into Uniswap, dived into the lending markets. And yeah, it was pretty clear to me pretty quickly that there wasn't a really good solution for options on chain. And it made sense to me that options would be something you should build on chain because they're just such a perfect programmable primitive, right? Like, you can compose options to make any payoff you want, right? Like between different structures of calls and puts. And I think that lends itself really well to creativity and programmability. So that's what got us, building Lyra in sort of early 2021.
So I think one of the main things to me that I really like about Lyra is that it's actually an AMM model, which a lot of people poo-poo AMM models, but in a way, to me, those are like, there's such a demand for passive yield and being a passive LP in crypto that to me, it just seems like a natural fit. So like, what made you want to create an AMM versus like an order book style with traditional market making roles and stuff like that?
I think just straight off the bat, we think it's like a better way, like the best way to provide the best options experience for people right now. And it was in 2021. I still believe it is in 2022 and probably will be for a while. At the very least, if you look around at some of the order book protocols, right, like OpenV1 did a really great job. They built an astonishing product with like a really cool partial collateralization mechanism. But the fundamental truth of it was you couldn't do it with L1 gas. Like, no one's going to make a trade. Options trading can't really exist when you have to pay $50, $60 in gas for a trade. Not only that, the order book problem is so much worse for options than it is for, like even perps, right? Where like you have one asset ETH and you have a bid and ask for ETH, and there's obviously more complexity to that, but you only have to update your quotes for one underlying. For options, for each underlying, you have tons of different expiries, and then maybe like 10 to 20 different strikes on each expiry. You suddenly get to, and then a bunch of different underlyings, you get to this like crazy scale of bids and asks that need to be updated every second, even faster than that, frankly, that market makers demand. So you get into this spot where like it's just actually not tenable with blockchain technology or putting it on chain, and you have to make all these sorts of compromises for user experience. Maybe you go and build your own chain, which is kind of similar to what DYDX are doing. You take all the order book component and matching off chain, and that causes problems, as we saw with DYDX even yesterday or 2 days ago at the time of recording. And like for us, it was very clear that the AMM model had a ton of potential. We saw what happened with Uniswap. Fundamentally, right, AMMs tend to perform best when assets are like mean reverting, right? Like with Uniswap pools, the best pools with the tightest spreads tend to be like stable to stable coin, and the sort of worst sort of pools for a Uniswap would be something like a prediction market for a sports game, where like one goes to one team goes to one and the other team goes to zero, because that diverges and the passive LPs are left holding whichever one goes to zero, and the sort of arbitrageurs and the toxic flow get the sort of payoff. But vol, as you would know, right, like is kind of fundamentally mean reverting. So as long as you can control your risk and make sure that the AMM itself doesn't blow up, you have this sort of nice property where in theory ETH vol should kind of revert to where it's been trading in general, and there are scenarios where ETH vol can double, triple, and things like that, and we did see that happen a few months ago. But in general, we think it's a very good fit for an AMM, and we think we have, like if you look around on chain today, if you're looking at like where can I trade options, like I don't think you'll find a better experience at order book or otherwise, and that's kind of why we set out to build the AMM in the first place. We think, to meet the market where it is now, it was the best solution.
Yeah, that makes a lot of sense. And so for anyone who hasn't read the white paper, it's pretty impressive. You guys go into a lot of the details of where pricing inefficiencies are and how you guys handle them. So you guys talk about delta hedging, which is the obvious one, and then you guys have a pricing mechanism to essentially Vega hedge in a way, or compensate the AMM for taking more and more Vega risk or short Vega risk. And then you also have built-in fees. So like there's a spot fee, a variance fee. I think there's another one that I'm missing. Can you just maybe just touch on that so users can know where the sources of returns are coming from passive LPers on Lyra?
Yeah, so fundamentally the source of returns for passive LPs on Lyra is from the spread, and the spread is like where you buy an option, and the difference between where you buy an option and you sell an option. And I think if you look at like Lyra right now, if you're talking like $110 option, the spread's about $5 or $6 for most of them right now on the platform. We expect that will come down over time as well. But this is a few weeks after launching Avalon. So when you buy an option for $100 and sell it for $160, you collect $6. Of that spread, you can sort of decompose it into smaller fees that we've sort of broken down and charge to make sure that the AMM is making edge and is protected in like severe environments. So the first one is the spot fee, which is kind of just like a percentage of spot that you charge. If ETH is 10 basis points or around that level right now. So ETH is $1,800, it's like $1.80 in spot fees per option. And that's to cover like delta hedging costs and things like that for the AMM, to make sure that it can hedge those deltas and can get flat. The second one is this variance fee, which is like something new that we've actually added in Avalon. And the variance fee really kicks in times of like really high vol environments or big spot moves, which again protects LPs. In the case of like a massive sell down in ETH or a big market move or things like that. So that ratchets up as its exposure gets larger and as the sort of vol is higher. So if vol jumps from 100 to 150, suddenly that fee is going to kick in and increase the spread, so it widens out in order to protect itself in volatile times, which is very similar to what a market maker would do as well. The third one is the Vega fee. Yeah, so the Vega fee, as you described, like Vega is the change in an options value per 1% change in implied volatility. And if you have accrue a large Vega exposure in one way or the other, so maybe you're short a lot of Vega, if vol suddenly spikes, the AMM is going to lose a lot of money, and that's risk. So whenever you start to accrue and take on more risk, you charge more for it. So the way that spread works is, if you continue to add to the AMM's Vega risk, it will continue to charge you a heavier and heavier fee on one side, and it will charge you nothing if you're going to hedge on the other side. Maybe one day we'll get to a stage where it actually starts to pay you to take off some of its risk. It could be in the cards, but it's a little while off.
Yeah, so that's really interesting. So I want to just jump back to the variance fee, because there's a subtlety there that might be lost to newer folks. So the AMM is going to be pricing its options in implied vol terms, basically in reaction to how traders, which way the flow goes. So if people are buying more and more options, vol goes up. If people sell more and more options, vol goes down. And there's a skew component in there as well for the wings. But now you guys added a variance fee in case the market moves and no one's trading along the way, and now there's a big sort of opportunity for a toxic flow. The variance fee will compensate. Is that the idea?
That's correct. Yeah.
Cool. That's fascinating. And now, one of the fantastic things is that your AMM delta hedges. I mean, I think that's the only AMM options AMM that delta hedges. That's fantastic. So can we maybe just touch on how that process works and how often do delta hedges occur?
Yeah. So that process works by essentially, there's a keeper function that can be called once every 6 hours, and it will go and it's permissionless, anyone can do it, and it will essentially check. It will go through and iterate through all of the sort of open positions that the AMM has and calculate its net delta. And we can kind of do this because we're on Optimism, and Optimism has really efficient low gas fees for compute, and that's one of the reasons we sort of natively went for Optimism. We didn't even think about deploying this onto L1, and so it goes through and calculates the net delta of the pool, and we're integrated with Synthetic, so it will if it calculates that the pool is long 1,000 ETH deltas, which means it'll make $1 every time ETH goes up. Sorry, it'll make $1,000 every time ETH goes up $1 and lose 1,000 if it goes down $1. Then it will go out and short sell 1,000 ETH on Synthetics to get back to delta neutral, which Synthetics allows for short selling, which is one of the reasons it was an obvious choice for us to integrate with in version 1 and now in Avalon. Likewise, if it's short 1,000 ETH deltas or 2,000, it will go out and buy 2,000 ETH deltas. There is, I will say, just because it is delta hedged and just because we do all this, the AMM does all this Vega hedging and things like that, it doesn't mean it's riskless at all. And I want to stress that for anyone who's watching this and is wondering, does all this hedging mean it's risk? Absolutely not, right? There's still lots of different risks associated with options market making. Gamma risk. You can run out of delta hedging funds, which is possible, right? If the pool is fully utilized and the delta hedge is at its capacity. And the gamma move is large such that its delta goes again, might not be able to hedge. So there's lots of risk still there, but the AMM does its best to make sure that risk is as minimized as possible, so it can stay in the game and continue to make these returns. So that's kind of, I guess, the thing I want to emphasize as well, because I know a lot of people do equate delta hedged with risk free, and it's certainly not true.
Yeah, that's a great point to note. So one of the other things is right now we're doing synthetic ETH for Lyra. Those are the markets that are being provided. Theoretically, you guys can start offering markets on a bunch of different altcoins, and I think this is one of the beauties of DeFi options, and it's one of the most, stable edges that DeFi has against the rest of the world. It takes Deribit a long time to add Solana because they have to line up all their market makers. They have to line up a lot of infrastructure to do that. It seems like in the DeFi space, we could iterate a lot more quickly to offer more optionality on ERC20 assets. Do you guys have plans to do that?
Certainly do. We started very slow with Avalon. It's the middle of a bear market, new system. We wanted to see how it behaved. It's been, I think, 6 weeks since we launched. And we just wanted to launch with ETH. We had fairly low liquidity in there. We got to 4 million, I think, without any incentives, which was pretty awesome. But we wanted to make sure we focused on ETH, observed the pool had all our attention there to make sure the system was behaving as was designed and as expected. Happy to report that is the case so far. And now that we've sort of scaled up the ETH market, which tends to dominate still, ETH is by far the biggest market that we traded in V1, as well as I would say just generally across the board, it tends to dominate the volume. So we wanted to make sure we had enough liquidity in that market to really cater for traders and integrators and protocols that we're building on top of Lyra to access. And now with 20 million in that pool, we are getting to a stage where we can quickly spin up other markets and it sort of fracture our attention, I guess, across different assets and things like that. So I do think that's going to be on the cards in the near future.
Cool. And then what about something like spreads that recognize the other option as like a collateralized spread? So let's say I'm getting long a butterfly. Is there plans to have the AMM recognize your existing position, or maybe lock up your long option to offset your short option sort of thing?
You can't do that now. I will say that that is one of our big strategic priorities in the near future. So that's something that's in development right now.
Oh, cool. That's fantastic. And so Lyra obviously has a token in the market. So what's the value proposition as a token holder? Is there sort of fees that go back? What's the tokenomics? What do those look like?
There are no fees that go back. It's a governance token, right? So the Lyra Council is elected every 4 months, and it's a sort of delegated council model, so people can vote in different council members based on their token holders, and they make decisions that are in the best interest of the protocol. Lyra is DAO first from day one, so it's purely a DAO, and so token holders have full control over all aspects of the protocol. I will say that right now, if you come onto the platform, we do have optimism incentives and things like that for Lyra stakers. So there's a recently sort of launched program where you can take your Lyra tokens, stake them, and earn optimism and Lyra rewards. And then that sort of acts as your gateway into LPing and hopefully soon trading rewards as well. So users who stake Lyra can access greater boost on their rewards for depositing into the liquidity pool, as well as hopefully in the near term, next couple of weeks, get rebates on their Lyra trades. So for now, we think those are we want to drive governance tokens into the hands of the power users of the protocol, and we think this is a really good way to do that, and that's kind of what the council's determined with that suite of programs.
Yeah, that makes a lot of sense. And so kind of just wrapping up here, obviously you're really busy with Lyra. I'm sure you probably have very little time to do things outside of programming and running a company, but do you find time to do anything else for fun or hobbies?
Yeah, I mean, I play soccer on the weekends. I play soccer and basketball in sort of social leagues. I actually just did my ankle on Monday, which wasn't so great. So that might have me out for a couple of weeks. But I do like to do things particularly that don't involve thinking when I'm outside of work, just because I think about things all the time and it's very hard to switch off from crypto. So things that force me to switch off, like playing basketball, going playing soccer. I just moved by the beach here in Sydney as well, so going down there a fair bit and things like that really helps to sort of take you away from crypto Twitter and all the craziness and all the madness in the markets and things like that. So that's what I try to focus on in my spare time.
Yeah, nice. And then for anyone who's new to options or new to trading, is there any books that you recommend that you enjoyed a lot as you started your career?
Yeah, I mean, dynamic hedging, I think, is the obvious choice, right? The Taleb book, which is a more sort of in-depth options heavy theory book. But I will say if you just as important as options theory is kind of just knowing the ability to make good decisions. And I think in that vein, Thinking Fast and Slow is again a kind of a canonical book here, but a very good one to understand what people's biases are, where the pitfalls of your sort of mental models can be. And I think it's a really important one to understand where your head is at, where you might be making mistakes, as well as things that the market in general might be mispricing. So I do think those are like a couple of good books that kind of sit on the either end of the sort of very technical to not so technical end of the spectrum.
Yeah.
But being a good decision maker is just as important as like having the exact quantitative model sometimes.
That's awesome. So that's Thinking Fast and Slow by Daniel Kahneman, and then Nassim Taleb's Dynamic Hedging. Cool.
Yeah.
Great books. Well, Nick, thank you so much for coming on the podcast. I think listeners learned a lot. I learned a lot. And everyone who tuned in, thank you so much for tuning into the GVol podcast, and we'll see you next time.
Appreciate your time, Greg, and it was great to be here.
Thanks, Nick.